Good afternoon, ladies and gentlemen. My name is Osama Abbasi, and I'm the CEO of Credit Suisse here in Asia Pacific. I'm honored yet again to be introducing the great list of speakers that we've arranged for you this week. Today, I'll be welcoming three of the world's leading central bank governors to our final session of this year's 2012 Asian Investment Conference. Dr. James Bullard, Mr. Norman Chan, and Dr. Subir Gokarn. I believe it's entirely fitting that our AIC should culminate in an expert discussion of what continues to be the biggest single influence over economies and markets in 2012 and beyond. Basically, central bank policy. Quantitative easing and asset repurchase programs are familiar to us now, but the scope and scale of the central bank response to the 2008 financial crisis was unprecedented. The Federal Reserve's balance sheet has tripled in size since 2008, and it's also signaled recently its intention to keep rates close to zero until at least 2014. After the LTRO operation in the Eurozone, the ECB's balance sheet has also grown substantially. It's acknowledged today that this extraordinary response, both in Europe and in the US before that, were crucial to stabilizing the global economy after 2008 and encouraging its gradual recovery since then. But equally, these responses have brought with it new challenges, like when to withdraw the stimulus without undermining the global economy and the recent recovery. Our panel of senior central bank governors today are in a perfect position to help us better understand the priorities of both developed and emerging central banks in 2012 and beyond. I am sure they will share with you some insight into the thinking and decision-making process of central bankers. It will be a privilege for all of us, I believe, to hear from them direct. I am sure many of you attended Dr. Bullard's keynote address this morning, but allow me to briefly introduce him yet again. Dr. James Bullard has been President and Chief Executive Officer of the Federal Reserve Bank of St. Louis since 2008, and he participates on the U.S.'s Federal Open Market Committee. He sits at the policy decision-making table of the world's largest economy. We're also honored to be joined by Mr. Norman Chan, who has been the Chief Executive of the Hong Kong Monetary Authority since 2009. Mr. Chan was appointed an Executive Director of the HKMA when it was established in 1993 and was Deputy Chief Executive of the Hong Kong Monetary Authority from 1996 to 2005. He was Vice Chairman in Asia of Standard Chartered Bank between 2005 and 2007. Our third panelist, Dr. Subir Gokarn, Deputy Governor of the Reserve Bank of India, also spoke to you this morning. He oversees monetary policy, research, financial markets, communications, and deposit insurance at the RBI. He also represents India's central bank at the G20 Deputies Forum. Before joining the RBI in 2009, Dr. Gokarn had a distinguished career in both the private sector and academia. Our moderator for this discussion is Bunt Ghosh, who, as you know, is our Vice Chairman of Fixed Income for Asia and also the global head of our strategy and risk for emerging markets in the asset management division here at Credit Suisse. We are really fortunate to be joined by such an esteemed group of panelists who are helping us to bring the global agenda as well as the regional dynamics here to Asia Pacific, to our audience here in Asia Pacific at the AIC. Please join me in welcoming them to the stage. Thank you.
Ladies and gentlemen, welcome to the last event in what I'm sure you'll agree has been an absolutely terrific Asia Investment Conference. We've saved the best to the last. It's not just the best in terms of the fun we're going to have, it's going to be the best in terms of what you're going to learn. So kick back, relax, but not too much. We need to ask some penetrating questions. The format's going to be, we're going to try and keep it as discursive as possible, as free format as possible. We're going to ask each of our distinguished panelists to spend 5 or 6 minutes on what they see as the main challenges for central bank policymakers in the years ahead. And then we'll open up to questions. If you don't ask the questions, I'll come over and make you ask them. So, Dr. Bullard.
So do you want me to go up here?
No.
No, you don't.
Be comfortable.
Okay. Okay, so I think I'll just outline, the title of the session is Challenges for Central Banks Going Forward, so I'll just outline 3 challenges. They're not going to be too surprising, but let me just outline them here. I think the first challenge for central banks, like the Federal Reserve, get back, how are we going to get back to a normal monetary policy in a reasonable amount of time without either derailing the U.S. recovery or allowing too much inflation, allowing inflation to start to run up and getting behind the curve. I've been increasingly worried that this is going to be a even more difficult task than I've previously thought it was going to be. The U.S. has a very large balance sheet, as you guys know. We've also got new policy tools, which are sort of untested, so we're paying interest on reserves, which we've not done in the past. How is that going to interact with the policy rate as we try to move out of extraordinarily easy policy? So I think this challenge of getting back to a more normal policy environment is a big one, and I am concerned that somehow what's going on in the current situation is sort of a permanent change or quasi-permanent change in the way central banks operate, and that this could get embedded for a long time going forward, and maybe it wouldn't be the best thing for economic performance. So I am concerned about that and concerned about our ability to get back to a more normal policy environment. So that's number one. Number two is regulation of financial markets and getting the right amount of regulation in financial markets, getting the right rules in place. Obviously, there's been a lot going on in the U.S. in terms of the Dodd-Frank Act and many other impacts on large financial firms and really all banking, smaller banks that I see out in the middle of the country as well. So the regulatory landscape has changed dramatically. I doubt that we have exactly the right rules in place right now. So I think the key thing is to be able to be flexible enough going forward to get to discard the things that maybe aren't working so well and use the rules that are working well and get to the right level of regulation. Above all, I think we want to get market discipline on large financial firms and not have the too big to fail problem in the U.S. And this is a huge challenge. I think the big firms are viewed as implicitly supported by the government. This is an intolerable situation inside the U.S. politically, and somehow we have to find a way to get the market discipline back on those firms, but still be able to get the financial intermediation that we need to get capital to move to the most productive uses. So that's a big challenge going forward. So I'm saying that even though a lot has been done in that arena, we're probably far from finished if the goal is to get to the optimal level of regulation. The third thing I would say is that a little more esoteric topic, but the notion of monetary policy cooperation in a world of increasing globalization is a very important topic, I think, going forward. So there was a time when you could view some countries more or less as islands, that operated like the U.S., saw themselves as not that connected with the rest of the world. There was some connection, but not that connected, able to pursue their own policies. The increase in globalization is connecting everybody together. We all understand that, but it's also changing the role of international policy cooperation. And here's one thing that I really I have in mind. I think in an increasingly globalized world, if you have poor policy in one country and good policy in several others, the poor policy from the one country spills over and has effects on everybody. So I think that's a notion of international policy cooperation that has not been there in the past. The notion that, gosh, if somebody's staying too low for too long, and that's encouraging a bubble, well, that's a bubble that's going to spill all around the world and have effects on all these other countries. So this is a very difficult thing and something I think that we're only coming to grips with in the policy now. So I would see that as a major challenge going forward. So the three I'm listing are how to get U.S. monetary policy back to normal, how to get the right amount of financial market regulation going forward and to increase market discipline going forward, and how to get better international policy coordination in a world of increasing globalization. So, thank you.
I've been warned by the moderator before lunch that this has been a long week for all of you, or most of you, and you are tired, if not exhausted. So try to avoid long speeches and make this session interactive. So I'll just make a couple of very brief remarks to kick off. Challenges ahead for central banks. I think in order to do that, one has to really do a bit of looking back to know where we stand, why we are here, where we are, before we can talk about where we go from in the future. Now, I think to me it's very important to note that I think central banks, especially the Fed and the central bank in the advanced economies, did a great job in launching the necessary measures to rescue the financial system, the global financial system, from a meltdown towards the end of 2008 and the beginning of 2009. It was a very, very difficult time. So that is no doubt about it. Credit to central banks and policymakers. But the question is, with the Fed's quantitative easing started, I think in March 2009, they've done a second round, and the QE3 may not be introduced. Huge amount of liquidity in the banking system. The same for Europe, LTRO, $1 trillion injected in the banking system. It has helped salvage the financial system, but to what extent it is effective in jacking up, reflating the economy? I think the effects is less than clear. I think lots of them argue that they're not very effective in stimulating the economy as originally planned. Now, I want to sort of touch briefly three possible explanations as to why this quantitative easing, credit easing, huge amount of liquidity injected in the banking system hasn't helped that much. I think the first point in the US, the bursting of this very big housing bubble has inflicted very big damage on household balance sheets. And these households were heavily geared before the crisis, in the years before the crisis. And we look at the household debt in terms of the leverage. At the peak, it was 1.3 times debt to income ratio. It's coming down because it's by necessity, it's deleveraging. It's gone to 1.13 times, but still, depending how you measure it, it's well above historical peak. That could mean that the leveraging process will still have some way to go. And that is bad news for consumer spending and therefore, and also investments as well, given that the housing market in the US is still in a very subdued state. So a lot of positive effects that this abundance of liquidity in the bank system could bring about has largely been diluted or eroded. This is the first point, first explanation. The second one has to turn to Europe. We all know that the problem in Europe is very complex. The problems in the banking system is actually exacerbated by the spillovers of the sovereign debt crisis, sovereign debt problems. We have 2 rounds of LTROs, over 1 trillion euro injected. This has provided much needed relief to the funding pressure for most European banks for at least the entire year, but these LTROs have not removed the need for European banks to recapitalize themselves, and for many European countries to solve the problems of fiscal sustainability and the lack of competitiveness of their economies. So that is another reason explaining why the economy has not been very active. And the third explanation is that while this low for long monetary policy is good, clearly for debtors, those who owe money, and banks, and it may slow down the necessary structural adjustment of the banking corporate sectors in many places. And more importantly, is a point that is often overlooked, is that while you have a lot of debtors who may benefit from this low interest rate environment, there are many prudent savers, me included, of course, pensioners included, they're being punished. They're punished. And this low interest income that many of them used to depend upon for the daily spending may lead to reduced spending and higher saving rates by these people. This, again, would dilute and offset the benefits that could bring about by low interest rates. So these are the kind of three, I think, a possible explanation why monetary policy, very loose monetary policy, has not brought about the kind of economic stimulus as people think. Now, coming back to the priorities for central banks in 2012 and beyond, of course, Dr. Bullard talked about this challenges tree, but for this part of the world, in Asia, the priority of central banks in Asia must clearly be price stability. And this is a good end, financial stability. I know in some parts of the world, it's still being debated whether central banks should divide its attention away from price stability, should also, in the US case, employment, of course, but in some cases, financial stability. But in Asia, most central banks take financial stability as part of the mandate. Because to me, it's quite clear that without financial stability, we are in no position to talk about anything else. Growth, job creation, social and political stability. I think we don't have the condition to talk about these issues. Now, in Hong Kong, this year we're facing a rather unusual situation because central bankers are paid to worry. Of course, I worry a lot, and therefore, to help me, I do have a radar. And I look at radar screen 24 hours a day, try to sort of detect signals of trouble, risk, and vulnerabilities. Now, in my radar screen, in around 3-4 months ago, my radar screen flashing is all red, but it's basically something to do with the European situation. The risk of an imminent meltdown of the European financial system and maybe euro itself. So that was a clear, biggest risk. But now the situation has stabilized somewhat. LTRO, 2 rounds, fiscal compact, making good progress, the Greek package, the PSI, everything done. So the confidence has gone up a bit. So that side of the downside risk has kind of diminished somewhat, but it's still there. But at the same time, in my radar screen, another risk emerged. That's the risk which we encountered back in 2009, 2010, is the renewed risk of housing price bubble in Hong Kong. Because in this very low interest rate, low for long, real interest rates are hugely negative. And lots of people will come to the simple conclusion. It means you buy brick and mortar, tangible assets that will preserve the purchasing power. And so even though in Hong Kong's case, we have introduced 4 rounds of, we call it counter-cyclical macro-prudential measures that basically to tighten the lending underwriting standards to make it harder for people to borrow mortgage finance. Nowadays, anybody walking the bank to buy a new apartment block will probably have to have 50% down payment. If your income is not derived in Hong Kong, you probably have to put down 60% down payment. Maximum is 40%. We also have what we call debt servicing ratio test. That means you cannot use more than 50% of income to service your total liabilities. So this is pretty stringent. I mean, and pretty novel, I think, in some places like the United States and the UK. But we practice that in Hong Kong. But again, on my radar screen, I have this flashing again, once again. I didn't see it. I couldn't see it 4 or 5 months ago. So it did remain a challenge. Of course, on the mainland, I think clearly inflation. Inflation is easing, so signs of easing, but it could come back up again. Commodity prices, oil price is a wild card. It's very expensive now. Could it become even more expensive going forward? And again, clearly, financial stability in China is key. Therefore, they have taken a lot of rather stringent measures to curb the property market bubble. So I think in this part of the world, you talk about going back to normal in the US context, exiting, I mean, I take it to mean, but in Hong Kong and Asia's case, we talk about watching against the risk of downside, deterioration of situation through the trade and investment banking channels. At the same time, this risk of renewed credit-fueled asset bubble. I'll stop here.
Dr. Kukaran.
Thank you. Well, I have to say that in the 2.5 years I've been in central banking, this was the first time I've heard fun and central banking used in the same sentence. So, you learn.
It's kept us going for the last 4 years, That's what kept all of us going.
I was told that if I wasn't dour and gloomy all the time, people wouldn't take me seriously. So, maybe I have to.
I want to give you a new image.
I'm trying. I think the key challenge that I would like to highlight is essentially that we don't lose sight of our primary mandates as central bankers. And this could be, of course, either inflation on its own or some combination of inflation and unemployment or output or growth. But notwithstanding all of the other developments post-crisis, whether it is in terms of questioning the narrowness of central bank mandates or the need to coordinate and sort of act in concert with other parts of the regulatory and policy framework, that the central bank is the primary sort of primarily responsible for inflation. I think that can get a little diluted in scenarios where you're pushing many other objectives. So maintaining the primacy of that and keeping the focus on that, I think, is important as you try and deal with the other interfaces that have emerged. But at the same time, very clearly, exclusive focus has come under question. And I think it's now quite easy to see that not being sensitive to other pressures that emerge from other sources, which I'll talk about as the next two challenges, can actually disrupt the whole thing. And so some consciousness and responsiveness to these other challenges, either on your own or in combination with other parts of the policy establishment, I think is an important sort of, let's say, a new or the re-emergence of a priority post-crisis. So what are these two points of interface? The first is external, and very clearly the turbulence that we've seen in the external environment I speak from the Indian perspective, but I think this is a generalizable statement for emerging markets in general, emerging markets as a whole. The volatility of capital flows, the impact of commodity prices, and somewhere underlying that, perhaps the spillover effects that Dr. Bullard referred to, that the consequences of monetary policy or other policy actions in large economies that have a spillover. We saw a great deal of concern about this in the G20 in late 2010 with the notion of currency wars and so on. And that I think the critical issue there is the recognition that there are many things that are going on outside that have a dramatic influence on domestic economic performance, but over which domestic policymakers really have no control at all. So how do you deal with this? Do you achieve policy coordination? Is that something that is it easy to do? Definitely not. But is there a sort of reasonable framework within which it can be done? I think that's really been the focus of G20 after the crisis, in the years following the immediate crisis management objective. And it's still work in progress. Very clearly, we don't yet have a clear framework in which this can be done. But in the meantime, challenges of dealing with the exchange rate, with the volatility that exchange rates have seen in an environment where balance of payments pressures are quite acute because of oil or other commodity prices, because of sluggish export growth to the major markets. All of that, I think, is bringing a huge amount of stress on the external sector, And this is being compounded and aggravated by the way in which capital movements across the world have been taking place. Risk on, risk off, it's a daily, you wake up in the morning, you talk about your radar screen. I mean, it's, you wake up at 6 to see what's going on in the Asian markets, and you wait till midnight to see what's going on in the American markets. So that your day is bounded by what's happening in markets around you to get a fix on what might happen to you tomorrow. And I think that's really a very distinct change, I would say, in terms of focus and emphasis from our typical radar screen. We've become very much more conscious of what's going on outside. The third element is on financial stability. And here we've already heard reference to the sort of increasing interface between monetary policy and regulatory functioning. That is the need to ensure the banking system remains safe. So, as in terms of new capital, in terms of restrictions on asset allocation and so on, how does this fit in with the overall monetary policy framework? That's a challenge that we have to deal with. But I think there are other issues as well, which is, how do you organize a regulatory framework? We did see a tendency towards separation based on the notion that focus was important for central banks. One target, one instrument, forget about what's going on around you, or at least don't let that intrude. And now we see central banks actually coming back into very visibly into the role of lender of last resort, and not just for the banking system, which was the traditional function, but to other distressed entities as well, particularly sovereigns. And if we see that as a role that is now becoming entrenched as a result of the changed global environment, then I would say that if you're a lender of last resort, then you need much greater visibility on the kinds of risks that are emerging in the system. And to do that, you might actually have to think in terms of a reintegration of these roles, which has its own problems when it comes to organization and focus and so on. So we've seen that happen in the UK, a sort of bringing back of banking supervision into the Bank of England framework. In India, we never went the separation way, but it was the subject of a debate. And I think what happens there is, again, interface with a number of different stakeholders, other regulators, government, the owners of banks. So managing that balancing act is, I think, also going to be a challenge. So I would broadly say that what the post-crisis environment is at least suggesting to me is that the conventional role of central banking from a monetary policy perspective, which is managing growth and inflation targets or unemployment inflation targets, is really starting to get very bounded by these other threats. And I think just finding a way to reconcile them, I think, is both an intellectual challenge, certainly, but also a very, very significant operational challenge.
Thank you very much. I think we're going to open up to questions, and I'm going to take the privilege of sitting up here and asking the first question. One thing I found interesting in both your talks this morning, the couple of things that resonated across both talks. One was a certain frustration at the political masters and their lack of ability to execute on the budget and budget deficits and etc. The other was the focus on the fact that in this particular crisis, in this slowdown, the stickiness of inflation surprised you, given the scale of the output drop we saw. And Dr. Bullard, you sort of attributed to maybe we mismeasured the full capacity. We didn't have a real grip on that. And you had a very similar sort of diagnosis. Could we examine that a little bit more? I mean, it's curious as to why, given the scale of the output. I can understand that in some sense. The unemployment number was enormous. The response was enormous.
Yeah, I'd be happy to talk about that. So the notion of potential output really varies in the literature about what should you really be thinking about when you're thinking about potential output. And sort of the conventional thing really from a long time ago is just to at one time we produced this much output, so we should, and all the same people are here, and all the same capital is here, so we should be able to produce that much output. But that, I don't think, is the distance between that and where you are today. So after December 2007, the U.S. fell off a long ways. Since then, we've been growing in parallel with that. So people say that the output gap is very large on that kind of basis. Is that really the right gap to be talking about from a monetary policy perspective? If you read the literature, the answer is absolutely not. That's, if you read sort of the new Keynesian guys, that all this theoretical stuff, well, that isn't the right gap. The gap is supposed to be how much output would be produced if prices were perfectly flexible versus the amount that would be produced in the sticky price world, and then that distance would be the right distance. So we've got a long ways to go, I think, on conceptual issues about the output gap. That's number one. Number two, this was a burst of a housing bubble in the U.S. So I want to think of the mid-2000s as the economy might have looked good, and you might have liked some things about that economy, but that economy was a sick economy that was, and output was artificially high because of the bubble. And what was driving that bubble? Absolutely clear. It was the notion that house prices never fall in the U.S. on an aggregate basis. That was the basis both for people borrowing a lot and buying houses, and also for the structured products that ended up doing so much damage. And so this is a widespread belief. When that belief went away, that whole thing was crushed. And it wasn't just, some people sometimes say, well, that was just the construction workers who were put out of work. Okay, but it's not just that, because it's all these ancillary industries that are feeding into that process and feeding into the bubble. So you want to think of the mid-2000s as being too high, artificially high. Some of that blew up and went away. This is a big crash. Now you've come back some. Maybe you've come most of the way back to an appropriately defined potential, a lower line that you would draw through the data that would more appropriately say, account for the fact that that was a bubble era and there was some artificiality in that growth in the middle 2000s. And you've come some way back, but maybe most of the way back to an appropriately defined potential output. That would explain several things that are going on in the U.S. that have been puzzling from an output gap perspective. Inflation went up in 2011. It was supposed to go down, stay the same or go down because of the large output gap. Instead, it came up. That suggests the output gap is smaller. Unemployment has come down faster than would have been projected if you really had a very large output gap. So there are some things that would start to make a lot more sense if you were willing to say that potential output is a little bit lower than what is sometimes portrayed. So I'll stop there.
I think the learning we have from our own historical experience, and I would specifically refer to the mid-90s to now, last 15 or 16 years, is that the output gap is variable. It's something that changes over time, and there are a variety of reasons that contribute to it. But I would perhaps emphasize from our perspective the sensitivity of it to the nature of growth drivers themselves. Because I think, as most people who have any experience of India would acknowledge, that we have a spread of capacity bottlenecks across the system, and to the extent that the pattern of growth tests these one or more of these bottlenecks, you start to have inflationary pressures emerging at different rates of growth. And I think that's a reality we have to live with. The long-term strategy clearly has to be to, having identified these bottlenecks, to try sort of consistently to reduce them or to eliminate them. But in the short term, that makes it rather complicated in terms of working on the notion that there is some absolute number out there which will trigger inflation, whereas if you're below that, it won't. And we've seen this number, I think, vary from 7% in the mid-90s to 8.5% plus in the early 2000s. And at now, there's an ongoing debate, but somewhere between 7 and 8 is where I think the weight of opinion would lie. and it's something we have to test, because without having a good fix on that, the policy, anchoring the policy becomes very complicated. But that it's variable, that it changes quite quickly, and is sensitive to underlying pattern of growth, I think is a learning that we clearly have to work on.
Mr. Chan, do you have?
I think it's important to try to understand more about output gap, especially in the States. But to me, I think it's another important lesson that we learned from the US experience during the lead up to the global financial crisis, that when you look at all the conventional indicators of price stability or inflation pressure, they did not tell you anything which is very wrong, right? I mean, James, you talk about it was a sick economy, but it was kind of looking back. We now know it was quite wrong. But the risk to financial stability actually accumulated over these years, and then led to it just blew up to a scale which is unprecedented, and shaking the core of the global financial system. And therefore, we now know that even in what we believe to be benign inflationary indicators, price, wages, whatever, there could be the segment of the financial sector which is actually getting out of control. And then if you are not careful, you don't look deep enough, then this risk will become big risk, and big risk become a financial crisis. And I think the US has paid a heavy price for that mistake. And this is something I mentioned in my opening remarks, is that it's okay it's necessary to look at inflation, but it's not a diversion of attention, because it's crucial. I mean, I know there's different philosophies on this point, but to me, it's very straightforward. If central banks do not look after financial stability, who can? All right? You can set up an agency to call Financial Stability Agency, but that agency, if separated from central banks, would not have the ability to create and generate liquidity in times of need. And what we have a situation in which one agency would determine, I need liquidity now. Central bank, give me the check. That's not acceptable. It doesn't work in practice. So somebody with a deep wallet with the responsibility, must be given the power to monitor financial risks in the system. Or else, the whole thing would be a disconnect. And therefore, those people without the kind of, they may have supervisory powers, but have no resources to rescue the system in case of need. Whereas another agency has the resources, but have no no way to monitor the system. So it's not very, very, I think, workable. So I think the message is that if the policymakers, the government doesn't think the central bank is the right agency, please designate one. Make it very, very clear. This particular agency has the mandate, powers, and resources to deal with financial crisis.
Thank you. Let me open it up to the floor. Questions from the floor, a raft of hands. Let's start over there in front.
My question is for Dr. Chan. You made a very valid point about negative savings for prudent investors. There's almost a 3 to 4% tax on capital through negative real rates. What can you do to address that, especially if the US remains irrational for a prolonged period of time?
It's hard. Therefore, the IMF is now conducting spillover study and spillover reports that, for example, monetary policies by the US authorities, by Euroland, by China, in addition to dealing with the domestic issues, what are going to spillover effects? So we have very low interest rates in Hong Kong, but although Hong Kong dollar is linked to US dollars, wholesale rate, interbank interest rate are close to zero, comparable to the US interest rates. Our domestic deposit rates and lending rates have moved up by 200 to 250 basis points over the last 2 years. Mortgage rate used to be 2 years ago, let's say, less than 1%. Can you imagine it? 0.7% to take out a mortgage loan. Now it's 2.5%. So it's gone up quite a bit. So the pricing of domestic savings and lending has gone up quite separate from what is happening in the States, because that has affected the domestic supply and demand conditions for Hong Kong dollar. Right? US dollar is more globalized, so the interest rates in Hong Kong for US dollar track closely the global markets. What can we do? I think apart from tackling the supply side of land, trying to produce more land, to sell to developers to build land, the government is speeding up the public housing program and also introduce a special tax, stamp duty, we call it, to dampen short-term speculation. But on my side, because my mandate is to safeguard banking stability and not directly tackling so-called property market per se. I want to make sure banks, when they lend to borrowers for mortgage finance, would uphold very high lending standards. So only lend to people who can afford to pay back. So the subprime situation will not be allowed to happen in Hong Kong. And we have introduced 4 rounds. That means since 2009, the latest round, which means you can only borrow up to 40 to 50% of the value of property, together with a very stringent income test. This is how we're dealing with the problem.
Just one follow-up question on that.
Actually, could we, rather than have follow-up, there are a lot of people asking questions. If you don't mind, let's go. I mean, I'm having to restrain myself because otherwise I have a follow-up that I'd like to go. And if I'm not going to be greedy, I'm not going to let anybody else either. So let's go to the back over there on the left.
Yes, I believe Dr. Bullard mentioned that one of the risks is that you have irresponsible central bank policy that sort of washes, because of the global economy we're in. I'd like to ask the panel which countries they think currently have irresponsible or distorting monetary policy.
Dr. Bullard, you've got to lead there.
Why are people looking at me? I guess the main idea that I would have on this, and I did talk about it a little bit, but the too low for too long is often associated with bubble phenomena. Okay, so what you're really worried, and is it just U.S. policy? Well, no, it's basically G7 policy. But what you worry about is you create some kind of bubble and it just expands all across the global equilibrium, and the individual countries around the world can't really combat that because that's just part of the global equilibrium. So I think people for a long time have had the idea that if you took care of your own country with a flexible exchange rate and you took care of your own country, then good monetary policy in your own country, things will be fine in your own country. But it's a global equilibrium. So if there's something wrong with the global equilibrium, affects everybody, and there isn't that much that the individual monetary policymakers in the countries that are running pretty good monetary policies can do about it. So I guess that's my main concern, and to me that's a little bit different concept than what we've had in the past on this issue.
Karan, do you have a view on the topic?
I think the sort of understanding of spillovers in terms of both the complexity of channels and the magnitude of the impact is fairly recent. Central banks are mandated to address domestic policy objectives, not global policy objectives, and to the extent that they use their instruments to do that, I think that's what they're there to do. Now we have had historical efforts to globalize central banking. We have some elements of that system still in place. We do have a sort of a lender of last resort in the form of the IMF. We do have a settlement system in the form of the BIS. And we did have a gold standard, which essentially meant that you had a global currency and your local domestic currencies were simply proportionate reflections of that global currency. Each of, at least the global monetary policy framework has obviously, in its historical context, been found to be somewhat inefficient for a variety of reasons. Can we visualize going back to that? Because, when you raise questions about spillovers, it comes back to the very fundamental issue, which is the only way to deal with externalities is to find an organizational way to internalize them, and that means, having some sort of a global central bank. Whether that is going to be a solution or not, I think is an intellectual question. But within the framework that we operate, it's very difficult to look at the formal introduction of some sort of global consequence into a policy rule. You may take cognizance of the impact. You may sort of put some weight on it in a judgmental sense. But I can't really. How do you measure it? What do you take into account? Some countries or the other. I mean, it is an extremely complicated kind of thought process.
Should we have a question? Let's have one at this end.
Central banks have actioned the quantitative easing actually quite differently where it has taken place, and with a different degree of flexibility with regard to exit and also with regard to their independence, especially at a time when public finances, for example, in the US, are quite sensitive to the cost of debt, so to interest rates. First of all, would you agree with that statement? Would you regard ECB and Swiss National Bank, for example, as more flexible with respect to their exit? And what are the lessons that central banks would take from that today?
For the Fed, we have spent some time talking about exit and have laid out a basic exit strategy. The committee has said that we will, and the chairman has said that there's going to be a certain stage of actions when it comes time to exit. There's a preferred way to do the exit. Of course, everything would depend on circumstances when the time comes. But a lot of that was done to partly reassure markets that we are thinking about this issue and to try to have a plan in place about how to do it. Could we be flexible in that plan? I think we could. Other central banks, I'm not as sure that they've laid out as clearly how they plan to exit. With Europe in recession now, exit seems farther away. They've been dealing with the sovereign debt crisis now for quite a while. But I would hope that going forward, we would see some planning go on so that, again, we can reassure markets that some thought has been put into this and that it can be done in a way that would withdraw the accommodation at the appropriate pace so that we don't get either premature withdrawal of support for the recovery or too much inflation that gets out of hand.
I have a question right in front.
Thank you so much. My question is that if exchange rate does not adjust for global rebalancing, economic force will find its own way in domestic prices. So lower real interest rate can be conducive to excessive credit creation. So my question is, can the central banks fight against such a pressure? And do you think the role of the central bank should be expanded to monitor quantum and volume of credit in addition to prudential measures to restrict credit so that the system will not respond to the wrong pricing signal?
Just one point. I think in Hong Kong, the problem is easier to deal with because it just happened that HKMA deals with both central banking, financial stability, controlling the financial resources in the form of exchange fund as well as banking supervision. So we have all the 3-4 things under one roof. So then we can actually take into account all these requirements rather than having to argue between, let's say, the central bank, which does not possess banking supervision functions, and therefore you have the problem about whether supervisor may think on a micro level, I don't see a problem. The underwriting standards are pretty robust. Bad loans ratio is declining, if nothing else, because from a bubble or cycles point of view, when let's say a property market bubble is on the rise, all the bad loans ratio, customer loan, will come down. You see the opposite, where risk is become bigger and bigger until the bubble bursts. And therefore, I think it's important that there's as I said, a linkage between the macro and micro prudential kind of perspective.
One over there.
This question is for Norman. Assuming if the interest rate remain low, my question is, what strategies, or is there any change of strategies on your part to protect your portfolio? That is to say, are there any change of strategies, to generate the same or higher profitability for your portfolio? So, i.e., if the interest rate remain to be low for many years to come.
You mean the exchange fund portfolio, right? Okay. I think this is hard. I've been telling the entire world that this is, last year was very tough. This year maybe even tougher. So it's very hard to expect a very impressive investment return. Last year, I thought it was already a big accomplishment not to lose money. Of course, and then we make a positive return, not a huge one. But this year, again, I think the market environment is so unstable. The stock markets, the global equity markets have done well so far since the beginning of the year. And most of them have gone up by 10, 12, 15%. That's good news. But the trillion-dollar question, can this continue? Can it be sustained? But for the bond market, it's hard because if you're holding on to a large bond portfolio, whatever market gains, we already taken, then the risk of the yield curve actually shifting upwards is material. And therefore, once that's happened, it's not good news for the bond investors. So it's a very difficult year for us.
But I'd like to thank our panel for very stimulating. And there were a few jokes. We laughed a fair bit. So it wasn't all doer. But thank you very much indeed for a very insightful presentation and panel. Thank you.
Ladies and gentlemen, this draws our 15th annual investment conference, Asian Investment Conference, to a close. I wanted to thank the speakers on the stage. Thank you, gentlemen. But I wanted to share all the speakers. I wanted to thank all the speakers that we had here this week, be it across corporates, policymakers, or clearly the central banks and former leaders. And I also would like to thank all of you, our audience, the investors that have made the time. I hope you found this insightful. And lastly, the Asia Pacific Management Committee at Credit Suisse and I would like to thank our internal staff and corporate events who've done a fantastic job of running a very seamless operation this week. But to all of you, thank you very, very much.